The most dangerous moment in any financial bubble isn't the crash. It's the moment when doubt disappears. That moment arrives when prices are rising, confidence feels earned, and skepticism no longer sounds cautious, it sounds outdated. Not reckless, not irresponsible, just behind the times. By the time the word bubble enters everyday conversation, the real work has already been done. Not by fraud or conspiracy, but by the human mind quietly persuading itself that this time is different. Welcome to its financial history too, where money, power, and history collide. And nothing is ever as simple as it seems. Every major financial bubble in history shares a strange characteristic. While it's forming, it never feels irrational. It feels sensible, responsible, even necessary. Participants don't believe they're speculating. They believe they're adapting to a new reality. That's why bubbles are nearly impossible to recognize from the inside. They don't present themselves as excess. They present themselves as progress. This pattern isn't modern, it's ancient. Long before stock exchanges and venture capital, humans were caught in speculative manias, centered around assets that promised a transformed future. Tulips in 17th century Holland weren't just flowers, they represented status, rarity, and a new kind of market. Railroads in the 19th century weren't just steel and steam, they symbolized national destiny. Radio stocks in the 1920s weren't merely companies, they were the sound of tomorrow. The internet in the 1990s wasn't just technology, it felt like the end of distance itself. Each of these innovations was real, and that matters. Bubbles are not built on lies. They're built on truths stretched beyond their limits. The psychology behind this process is remarkably consistent, and it begins with something deeply human: our need for stories. People don't understand the world through spreadsheets. We understand it through narratives. Stories explain cause and effect, they create meaning, they reduce uncertainty. And when a compelling story attaches itself to a new technology or asset, it becomes incredibly powerful. Belief comes first. The numbers follow. Once a narrative takes hold, valuation stops being the starting point and becomes an afterthought. Traditional metrics are dismissed as outdated tools from a world that no longer exists. Profitability isn't rejected, it's postponed. Losses aren't treated as warnings, they're framed as investments in inevitable dominance. When a story feels convincing enough, math becomes an inconvenience. This is where social proof enters. In uncertain situations, people instinctively look to others for guidance. If everyone is buying feels safe. If respected peers are confident, doubt feels unnecessary. Markets magnify this instinct because rising prices themselves become evidence. Every increase reinforces the belief that the story must be correct. Otherwise, why would so many people agree? Skepticism becomes expensive. Analysts who question valuations are labeled pessimists. Investors who stay cautious feel left behind. Career risk begins to outweigh financial risk. It becomes easier to be wrong with the crowd than right alone. From the inside, consensus doesn't feel like herd behavior. It feels like confirmation. Once consensus forms, confirmation bias takes over. Investors don't stop looking at data, they stop looking at inconvenient data. Positive signals are emphasized and repeated. Negative indicators are reframed, minimized, or dismissed as noise. Models are adjusted. Definitions loosen. Words like temporary, transitional, and long-term start doing heavy lifting. This is when bubbles become self-sealing. Any criticism is interpreted not as a warning, but as proof that the critic simply doesn't understand the new paradigm. Then comes overconfidence, the quiet kind. Rising markets reward participation. Early success feels earned. Gains are attributed to skill rather than circumstance. New investors believe they've discovered a rare opportunity. Experienced investors believe they've learned how to manage risk better this time. Everyone believes they'll exit before the collapse, even though history shows almost no one does. Luck feels exactly like intelligence, until it doesn't. Authority bias adds the final layer. When large institutions validate the narrative, doubt collapses. Major banks issue bullish reports. Governments celebrate innovation. Central banks maintain supportive conditions. Capital flows freely. At that point, the asset no longer feels speculative, it feels endorsed. Nothing signals stability quite like needing institutional reassurance to maintain confidence. And here's the cruel truth. None of this feels reckless while it's happening. It feels like alignment, like progress, like inevitability. Prices rise, confidence grows, and caution fades not because people stop thinking, but because thinking becomes emotionally inconvenient. This is why bubbles are rarely identified in real time. They don't feel like madness. They feel like reality finally being recognized. But consensus has a blind spot. You can't see the assumption holding everything together. By the time a bubble becomes visible, it already feels normal. That's the paradox. The psychology that creates bubbles doesn't announce excess, it numbs it. Rising prices become background noise. Volatility feels familiar. Risk turns abstract. Eventually, the question stops being, is this sustainable? And becomes, how do I avoid being left behind? Modern bubbles don't require hysteria. They don't need taxi drivers giving stock tips. Today, bubbles can form quietly, driven by institutions, indexes, and concentrated capital, with very few people questioning the underlying assumptions. Which brings us to the present. More investors are now asking whether we're witnessing the early stages of an artificial intelligence bubble. Not because it is fake, it isn't, but because expectations are expanding faster than the economics can currently support. This distinction matters. Every major bubble was built on something real. Railroads transformed transport. Electricity reshaped industry. The internet changed communication forever. The dot-com bubble didn't burst because the internet was useless. It burst because markets assumed instant, universal, perfectly monetized adoption. AI follows the same pattern. The technology is real, productivity gains are real. Long-term impact may be enormous. But markets don't price distant inevitability. They price near-term expectations. In recent years, a small group of AI-related companies has driven a disproportionate share of market gains. Index performance has become highly concentrated. This alone doesn't prove a bubble, but it is a familiar ingredient. Capital funnels into a narrow set of symbols, and those symbols begin to carry narrative weight far beyond their financials. Valuations rise not only on projected earnings, but on assumed dominance. Margins that don't yet exist are priced as inevitable. Heavy spending is reframed as strategic necessity. Profitability becomes something that will arrive later. Confirmation bias does the rest. Positive announcements are amplified. Adoption headlines are celebrated. Rising costs, competition, regulation, these are explained away. Skepticism isn't debated. It's dismissed as short-term thinking. Authority reinforces belief. When major funds and institutions allocate heavily to the same theme, participation itself becomes validation. The question shifts from what is this worth to what happens if I'm underexposed. That shift defines late-stage belief formation, not mania, not panic, just quiet alignment. And here's the uncomfortable truth. This doesn't require bad intentions. Most participants are rational. They respond to incentives, benchmarks, and career risk. When underperformance has consequences, caution becomes dangerous. That's how bubbles grow without excitement. They don't need enthusiasm. They need compliance. Bubbles don't burst because everyone suddenly realizes they were wrong. They burst because one assumption breaks. Growth slows. Costs rise. Rates change. Capital reprices risk. And when the core story loses coherence, psychology flips. Confidence doesn't fade, it snaps. Social proof reverses. Confirmation bias hunts for bad news. Overconfidence vanishes. Authority retreats. Liquidity dries up. What once felt inevitable suddenly feels fragile. That's why bubbles are obvious in hindsight and invisible in real time. So how do you protect yourself? Not by predicting crashes. Timing bubbles is nearly impossible. The goal isn't foresight, it's self-awareness. The real question isn't, is this a bubble? It's, what belief am I relying on? If growth slows, what breaks? If capital tightens, what changes? If expectations reset, what remains? When decisions are anchored in narratives rather than cash flows, timelines matter. When valuations depend on perfection, patience becomes risk. And when everyone feels certain, uncertainty deserves the most respect. History doesn't repeat because assets change. It repeats because psychology doesn't. Bubbles don't form because people are greedy or foolish. They form because belief feels safer than doubt, right up until it isn't. Those who survive them aren't the ones who predicted the future. They're the ones who understood their assumptions. That's the real lesson buried beneath every crash chart and post-mortem headline. If this gave you a new perspective, subscribe. History already has the answers.